In this video, we are going to talk about the equity market, specifically about common stock and preferred stock. Before getting into what a common stock is, let us revisit the accounting equation. We know that A equals L plus OE. Assets equals liabilities plus owner's equity. This means that all the assets in the hands of a company are financed by either liabilities and or owner's equity. So anything that is not a liability is that owner's equity, is the amount that represents how much the owners of that firm or company themselves own. And the common stock is the most explicit representation of this ownership. And usually, this ownership status allows the owner to exercise their voting rights. Remember, I said usually, because there can be exceptions, where some common stocks can be non-voting, or some common stocks can also have less of a voting power. For example, Google has multiple classes of shares. The founders themselves have a higher class of common stock, which gives them more voting rights compared to ordinary shareholders. The ordinary shareholders, the lower category stockholders, of course can vote, but their vote counts less than the upper class stocks. So, in short, common stock ownership can be both voting, non-voting, or limited voting. These common stocks also represent a residual claim. Now, what do we mean by residual claim? The word residual comes from residue, which means something that is left after everything else is taken off. In the case of a company, after the revenue or the sales come, they have to pay off all their expenses, and then they have to pay all their debt holders, interest payments, etc. And then they pay tax, and whatever is left after all of these duties and obligations are met is the claim of the shareholders. So you see where the residue comes from. So residual claim means that the stockholders will be last in the long queue of people who have claims on the assets and income or revenue of that company. Another distinguishing feature of the common stock is the notion of limited liability. You may have seen in the names of various companies LLC. LLC stands for Limited Liability Corporation. This term means that the owners or the stockholders of that company are not personally liable themselves. So let's say the company goes bankrupt. All of its assets are liquidated, and still they cannot pay off the bondholders or bank interests. So what would happen in that case? Would we be able to hunt down those shareholders personally? Well, we can, but legally they're not obligated to give us even a single penny because of this limited liability concept. This is an extremely important concept that safeguards the investors from the actions of the management. If you recall, in one of the earlier videos, we spoke about the principal agent problem. Now let's say, for argument's sake, I own a few shares of Boeing Company, the company that made the aircraft 737 MAX. Many of you probably already know what happened to the Lion Air flight, what happened to the ill-fated Ethiopian Airlines flight. These two planes crashed because of a failure in the manufacturing process of this particular aircraft, which was made by Boeing. Now, would this be fair on me as a Boeing shareholder to be personally held accountable for those crashes? Yes, Boeing as a company is responsible, has been negligent, and probably should be punished. But should I, a small-time investor who has nothing to do with aviation or airlines, should I be punished? The law says no. And this is a big relief for me because I had nothing to do with the production of those aircrafts. So, I hope you will be able to transfer this concept of limited liability to other scenarios where myself or you as an investor should not be held liable by the actions and activities of the management or the employees of that organization. And this allows people to be more active participants in the financial market because they're not scared that if the company makes a bad move or a mistake, they will be personally held liable and probably even go to jail. No one would buy a share if they know there's a risk they would go to prison for things that they had no control over. And that's why the concept of limited liability immensely helped in popularization of corporations and financial markets. Okay, next we move on to something called preferred stock. We know that equity is ownership and bank interests or bonds are debt. Preferred stocks are kind of a hybrid instrument because they have attributes of both classes, and yet they're classified under equity. The reason is there is a promise of a fixed dividend, which is in a weird kind of a way similar to bond coupon payments, that they're periodic on a pre-agreed amount. If you've ever invested, you should know that the dividend amount is never fixed. Every year, investors wait eagerly to find out what percentage of dividend the company would declare. Preferred stocks, the dividends are fixed, so one payment every year. In practice, even though the dividend is expected, there is no explicit obligation for the company to pay those dividends. But also, usually what happens is if the company misses paying a dividend, they will usually accumulate that and credit that for the next paying cycle and then pay both of them at the same time. But here's a big thing for you to remember. They are in line to receive the payment before the common stock holders. And recall that common stock holders, shareholders, are residual owners. So they are last in line. They can never receive a dividend payment if the preferred stockholders did not receive theirs. So preferred stockholders would receive their dividends after the bondholders, after the interest payments of the commercial banks, but before the common stockholders. Also, preferred stockholders do not have the right to vote at the annual general meeting of the company. With regards to taxation, we know that interest payments are tax deductible. Dividends for the preferred stocks are not tax deductible. And also, similar to some bonds, there can be options embedded along with preferred stocks. So they can be callable or they can be convertible. If it's callable, that means that the company who issues the preferred stocks can choose to retire them by paying off a price to the investors. And in the case of a convertible preferred stock, the investors or the preferred stockholders can choose to convert them into regular shares. Usually they would do this if they believe that the company has a bright future. Okay, next we move on to stock market indices. First, what exactly is an index? And why is it even useful? We see them all the time. Somebody comes up to you and asks you, are things getting more expensive in your country? Well, it's an easy question, but it's also a tricky question. How do you answer that? You cannot go to the stores and make a list of all the prices of all the goods and services in your country and then compare them to the prices yesterday, the month before, the quarter before, the year before. That is an impossible and impractical task. So instead, what we do, we take a look at inflation indices, the CPI, Consumer Price Index, or something similar to that. This allows us to quickly make a reference about whether things are getting more expensive or getting cheaper. Precisely the task of an index, to give you a snapshot, a quick overview. It is just like how a thermometer tells you whether you have an abnormal temperature or not, whether you have a fever or not. So, in the case of inflation, what usually happens is data is collected on prices of a basket or a portfolio of different goods. Let's say rice, flour, oil, salt, several of these essential commodities, and other services such as haircut, petrol price, things related to rent, standard of living, etc. And all of those are weighted in an index format so that all this information is captured by a single number. Similarly, in the case of a stock exchange index, it represents a basket or a portfolio of different ingredients. And the ingredients depends on the objective of that particular index. So we'll begin with a very famous index called the DJ, or the Dow Jones Industrial Average, usually called just the Dow. It includes 30 blue chip corporations listed in the US. And this index is considered to be indicative of the industrial performance of the US because the ingredients of this index are blue chip corporations, so very high quality with an excellent track record of business and an efficient, reliable board and top brand recognition. So, for example, some of the constituents of the Dow are American Express, Apple, Boeing, Caterpillar. You pretty much get the idea. Really top shelf companies. So the idea is if the Dow is going up, that means the best companies of the country are doing very well, which then reflects that probably the economy as a whole is doing well. Conversely, if the Dow is on a downtrend, chances are the economy is slowing down or is approaching rough times. Another highly popular one is the S&P Standard & Poor 500. This index has a much broader base. As the name says, 500 companies. So it incorporates a lot more companies than merely blue chip companies. But of course, all of these indices have their own criteria, and sometimes companies who fail to meet those criteria are excluded, and in their place, new companies are brought in. The criteria themselves can change over time. Now, aside from giving us an overview of how the stock market or the economy is doing, indices also have a very vital role for all investors, specifically investors who want to engage in passive investing. Let's say myself, a conservative investor, does not want to engage in active investing. Instead, I just want to ride the waves the same as the regular market. But doing this for me, let's say I begin with only $5,000. Achieving this market portfolio for me would be next to impossible. I would have to buy the entire market exactly as the same weight as the market, with high transaction costs and high monitoring costs. And not to mention, $5,000 is not even enough to buy the minimum lot of many stocks. So, does that mean I have to lose out on having a portfolio that looks like the market? The answer is no. There are mutual funds and ETFs, or exchange-traded funds, which mimic, copy, mirror, or recreate a particular index. So when you buy a share or a unit of those funds, you're buying a slice of a portfolio that looks just like the market or that index. So the end result is you as an investor, without spending too much money, time, or energy, are holding a market portfolio and enjoying, or suffering, the same performance as the general market. The people and the portfolio managers who make this fund possible achieve so by continuously updating their large pool of funds to buy all the stocks which are constituents of that index in the exact same weight and formula as originally intended. So, indexes are not just theoretical, they also serve a very practical purpose. Among the globally important indices, we also have the FTSE 100 in London Stock Exchange, the DAX in Germany, the CAC 40 in France, the Nikkei in Japan, the Hang Seng in Hong Kong, etc. So that concludes the brief video on equity market. I will see you next with a video on derivatives. Bye!